Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I am Jeff Snyder. I'm the lead anchor for the Broadcast Retirement Network, founder of the Morning Pulse, and your host for the next 60 minutes as members of the media, financial services, and academia go around the globe to discuss the issues related to retirement, markets, technology, personal finance, so much more. Glad you found us. Glad you're back if you are a returning listener. So sit back, relax, and enjoy this episode of BRN Sunday Podcast. Well, let's kick things off with a look at social media trends. And joining me on the line, Devin Banerjee. He is the Senior Financial Services Editor for LinkedIn. Devin, how are you?
I'm doing well, Jeff. How are you?
I'm doing well. Great to talk with you. Great to see you on BRN AM, which people can catch tomorrow morning. This airs on Sunday, so you can catch Devin with Social Media Monday as well. But Devin, always a pleasure talking with you. What's top of mind for you this week and on the platform?
Yeah, absolutely. A couple of really interesting conversations we started this past week. The first is one that maybe you and I contribute to by talking about it so much, but it's what experts are calling diversity fatigue.
Uh-huh.
So essentially, experts are starting to find, these are people who study gender norms and gaps and practices. They're starting to find that companies are often more driven by today a motivation to say all the right things around diversity and inclusion in their workforce versus actually attempting to drive genuine, meaningful change. So diversity has become, such a buzzword, and it's often regarded as kind of the politically correct topic that's best suited for audiences at conferences or in the media or in corporate training. That experts are starting to find that the amount of time and energy spent on the messaging, it's kind of overtaking or threatens to overtake the amount of time and energy spent on real life hiring and policy decisions. So I thought this was really interesting and kind of sad, but also interesting. And I can kind of see it. I attend a lot of conferences. I'm often the person interviewing executives and stuff. And when people aren't putting numbers behind it, or dare I say, even kind of quotas, which there's a lot of research that shows that quotas don't work, but some companies have gone that route. But without data and numbers, basically there's this threat, there's this risk that a lot of companies and executives are just using the buzzword because they know that plays well.
Yeah, I tend to agree. I mean, people are going to, it's up to the employees, it's up to the shareholders and the stakeholders, and it's up to the public to hold, especially public companies, accountable, right? I mean, we talk about this a lot, and I'm sure there are companies out there that are not walking the walk. They're just
Yeah.
talking the talk, and that's unfortunate because we
Yeah,
need.
and I'm glad you mentioned
Sorry.
employees and invest. No, I'm glad you mentioned employees and investors because, as I always say, kind of the people with power over the over the bottom line. So customers, employees, and investors. I think they are really in a position to drive change and apply pressure to management teams. Yeah.
But don't you? We've talked about. I mean, the numbers are there. Where we think we talked about it last week or the week prior about women who run companies or who are CFOs. I think it was a CFO story, right?
Yeah.
That actually had got better returns on the earnings. If
Absolutely.
I'm not
Yeah.
mistaken.
There's very high correlation among that. Another story we actually featured that ties into this past week was an analysis done by the Wall Street Journal, showing the 20 most diverse companies in the S&P achieved higher operating profit margins, 12% versus 8%, and enjoyed greater equity returns, 10% versus 4.5%, than the least 20 diverse firms on the index. So those polar opposites in diversity are showing quite a difference. So anyway, as I said, it's a bit sad that diversity and inclusion have become kind of just a talking point, but it's also not surprising. And I think we the media and investors and employees and customers really need to stay on that topic.
Yeah. Yeah. I mean, you got to hold people. I mean, look, if you are going to bring me a better return, I'm your best friend. I'm going to
Yeah.
invest in your company. I'm going to think about you more. And if that's done by X, Y, and Z, I mean, look, if my cat, and all, just joking, but if my cat could deliver a great return, Peaches over there is sleeping, instead of sleeping, I would hire her. But
Yeah.
so, putting all kidding aside, it's, oftentimes the more we talk about things, sometimes just people tune it out, and maybe it's we need to talk about it in a different way.
Yeah. Yeah. Absolutely. So another topic we featured that, again, is a bit pessimistic, and I apologize. I'll get to some more optimistic ones later in the segment, but this is one on, it's a topic we talk about all the time, and you are the expert in, young people saving and investing for retirement. So there was this report that came out last week that we featured from an MIT economist, finding that actually we're not focused enough on all the roadblocks that are between now and retirement for young people. So, obviously there's kind of a standard recommendation of putting 15% of your paycheck toward retirement. This economist is saying that's an outdated recommendation, and so he's saying that returns, we cannot rely on returns, for 401ks and retirement savings being as high as they have been in the past. He's saying we need to wake up to the fact that people are going to live much, much, much longer than they have in the past, et cetera. And so he's actually recommending about 40% of income being put to retirement savings over the next 30 years for millennials. So, obviously there's, everyone has different money kind of habits and practices and saving and budgeting. And as you and I have talked about in the past, sometimes these numbers become a bit meaningless to especially the young people who aren't thinking about this stuff enough. But I think kind of the scare headline of 40% really caught my eye and a lot of people on the platform on LinkedIn talking about it, because it just kind of there's kind of some shock factor at how big the gap is between what millennials are putting toward retirement now and what some people think they should be.
Yeah, it's interesting. The MIT just settled its 403B lawsuit, by the way, and I think paid like the highest settlement to I think it was $18 million to Schlichter Bogart, which is the law firm that represents the plaintiffs in this case. But I just think it's kind of ironic. But obviously one is not connected with the other. But it just kind of the ironies and ironies. But that is a lot of money to be putting away. I just remember, Devin, when I was 22 years old, which was quite a long ways ago, and I was not earning a lot of money, and I'm still not earning a lot of money, but I mean, I'm not earning a lot of money. I wasn't earning, I was just starting out, and I couldn't even imagine. I think I did save 15%, but I was also living at home, paying rent to my mother, by the way, so, before I get hate mail, and I think that's a lot of money to be putting 40% of your income, but not unexpected because of what costs will be, I think, right? I mean, what were some of the conversations, some of the feedback you got on that?
Yeah, so a lot of people were saying that, what they've been told and what they read, they're starting to realize is very outdated. And so when you look at all those projections or those tools that show you, how much to save, a lot of those assume that people are going to stop working at 65 and live maybe 20, 25 years. But if you look at those expectations for longevity and what the actuarial tables will be in the future, people are going to be expected, on average, to live way past, those figures. And so people are kind of waking up to that realization. I also saw one really interesting comment from someone who thought that because his dad has a defined benefit plan, a pension, a corporate pension, this young person on the platform assumed that his company had a pension and was saving for him, and he had never spent time to research that there was no defined benefit pension for him, and that it was actually it was just a defined contribution 401k option that I think he had not even researched, so it was just the default 3% or something of his paycheck. And so it's this education gap that you and I have talked about in the past. And I think more people are waking up to that realization that they need to spend more time researching their options and their path to retirement, because it's not going to happen for them.
Well, Devin, I think you have mentioned before on the program how employee benefits, it's not only companies that are practicing sustainability, that's important, mission driven, but also benefits. I think you did a story or a segment on a recent report that employee benefits drive a lot of decision making on where to work, right? Healthcare,
that's true.
Voluntary benefits like retirement.
Yeah, and I think that's an optimistic take on it. I think the more cynical side of that was that the benefits that attract young people are probably more aesthetic or surface level. So it's the free meals, it's the time off or the unlimited time off, it's the flexibility. Hopefully, more people are prioritizing the financial wellness benefits that companies offer. So 401k matching and advisory service. I actually just got an email here at LinkedIn this morning that we're going to have like Fidelity on-site consultants come. There are broker of choice for a 401k plan, so they're going to come on site for free consulting. So stuff like that, I hope, is rising in that list of priorities for young people when they're evaluating employers. Yeah. But we'll see.
Yeah. And then you got to give us. I was going to say you got to end on an optimistic note. You just depressed me and the rest of the audience. We got the whole show to go.
Well, this is maybe an optimistic note for introverts, which sometimes I consider myself one. But anyway, some research from the Rotman School of Management found that eating lunch alone every once in a while is actually very healthy. And so I found this interesting because there are a lot of workplaces that do lunch and learns or brown bag lunches, or they just encourage teams to eat lunch together and stuff like that. And I personally very much enjoy a lunch on my own every once in a while, maybe listening to music or catching up on a personal phone call or personal text messages. And anyway, this research from, as I said, the Rotman School of Management finds that it can be very reinvigorating, and it can re-energize you. It can make you feel more relaxed. It can make you feel less tired in that 3 p.m. Afternoon lag. And so anyway, for introverts, that is a positive story. Hopefully, every once in a while, it is encouraged to eat lunch on your own.
Yeah, we all need to recharge in different ways. Some extroverted are extroverts, and some, I myself, I like to be by myself to recharge, and I think that's a good point. And I think sometimes you need that to clear your head, like you said, and to think things through about what you're going to do the rest of the day or that night or the rest of the week. So I like that you ended on that note, because I think there are a lot of introverts out there, Devin.
I know.
I wonder if they did a study of introverts versus extroverts, what the percentage would be. Would it be like a 60-40 split, extroverts to introverts?
Well, yeah, I don't know. My colleagues and I talk about this a lot, and it's funny, in media and journalism, I think a lot of people are introverts, but we have this extrovert side we can turn on with a switch, when we're on stage or moderating something or sitting down, across from someone who we really need to draw out, from them a story. So I don't know. Yeah, there's this switch that a lot of people can turn on and off. I think I'm naturally more of an introvert, though.
Yeah. Well, I guess we will see. I'm going to do some research, and we'll bring it back to the audience next week of what the percentage is in the world's population. Devin Banerjee, it's always a pleasure talking with you, and we'll see you on BRN AM tomorrow morning. He's doing double duty as always, and he's a great sport. So have a great rest of your weekend, and we will talk with you soon.
Sounds good. Take care, Jeff.
Bye, Deb. Bye. Well, welcome back. Now we're going to shift gears to technology. And joining me on the line, he has made it home from Las Vegas, Nevada. Daniel Klein, Senior Technology and Consumer Products Reporter for The Motley Fool. Welcome back to West Palm, Dan.
Thanks, Jeff. As you probably know, coming back from Las Vegas is absolutely miserable. I didn't have a direct flight. You have to get up super early.
Yeah.
It's like 8 hours of travel, and when you get there, you're just exhausted. So, got a good night's sleep, raring to go.
Yeah, well, I'm so glad you're back and, recovering from a trip. As someone who used to travel a lot for work, I know how difficult it is. And so we appreciate you being on the program, and we also appreciate you making time for BRN AM outside of your normal business responsibilities. So a lot of things going on in the technology industry. I know we're going to tease out that we're going to talk Money 2020, which is where you were in Vegas for Tuesday. We're going to do a segment on BRN AM about that. But what's top of mind? Lots going on in technology this week for you guys.
So a lot of big companies reported, and for me, the most interesting one was Apple, because Apple had a quarter where it released a new iPhone, and year over year, iPhone revenue was actually down, not a terrible amount, about 9%. But what's interesting in Apple is how they've diversified their revenue. Wearables, which you don't think of as a big market segment, is almost as big as Mac. So you're starting to see the company services has been steadily rising. You're starting to see Apple balance out its revenue, its portfolio a little bit more, and be less reliant on iPhone. That said, I think the most exciting news I saw was towards the bottom of the earnings call. Tim Cook was asked a question about hardware as a service. Mm-hmm. And what that means is, were they considering, or at least this is how Tim Cook interpreted it, were they considering a subscription service for your iPhone? Meaning, you might pay a steady amount a month and be entitled to always have the latest iPhone. And maybe you get some other things. Maybe you get some extra cloud storage, the Apple Video service, the Apple Music service, who knows? You get a bunch of those things, and you have cost certainty, and the company has revenue certainty.
So, and then his response was there. I mean, I get that. Was his response positive, or he just said, I'll have to think about it?
He pointed out that a lot of people sort of do that themselves by how they finance their phone and working with different partners, and even how Apple offers financing and accepts trade-ins. But he acknowledged that they were actually working on and considering ideas that were closer. He didn't use the word subscription model, but I'll put the word in his mouth. Models that are closer to a subscription model. And it makes sense because I am a person who gets the new iPhone on the day it's released. And T-Mobile has a policy that you can trade in free of charge as long as you've paid off X of the original price. And after 12 months, I'm always a few months away from doing that. So there's always like that sort of one-time lump payment. And maybe there will be a year, and I'm sure there are people who aren't replacing their device because they don't want to change that payment, or they don't want, and this year it wasn't a more expensive phone, but a lot of years it has been a more expensive phone. So if you know you could always have the latest and greatest, and you change your phone at least every other year, meaning you always have a payment for your phone, you're really not changing your personal billing structure. You're just getting some certainty, and you're guaranteeing that you always have the latest and greatest.
Yeah, Dan, do you think that bundling is the future? I mean, I think you have chatted on the line before about Disney Plus, right? That's coming, and I think there are some service providers that are bundling that, like Verizon, I think, is bundling that. Is that the future that you think that these companies, in order to be successful, because it's not predictable revenue streams, do you think that's the future?
So I think offering at least one added service to pretty much any subscription has become sort of required. Mm-hmm. So T-Mobile gives you Netflix. Other people, AT&T was giving you DirecTV Live for a while. You got like 15 or 19 channels. I don't think they do that anymore. But there's pretty much every service like that is attached to something. And the reason it makes sense for Disney Plus to attach itself is that's a quick way to get subscription revenue. And you're probably taking a hit, but you can start reporting, hey, there's 30 million people watching, there's 50 million. You look more credible compared to your rivals faster. And if you're doing what Disney Plus does and you have a lot of really good content, you're exposing it to people who maybe otherwise wouldn't have seen it. And there's no way to build word of mouth if people don't see your content.
Yeah, let me ask you, Apple TV, I think, just released some of its first shows, or one of its first shows. Any Any reaction to that? Have you checked it out? I'm assuming you have because you're a
Yeah,
technologist.
absolutely. So I'm going to take a couple days off so I can watch The Mandalorian, which is the
Mm,
Star Wars show set in sort of the bounty hunter world of Boba Fett. For non-fans, probably still know who Boba Fett is. He's not the character on it, but it's another bounty hunter like him.
hmm
Some of the Marvel content coming out, and I forget which ones are being released at launch. But the Winter Soldier and the Falcon series, the Wanda and Vision series. For me, this service has way more things on it than Netflix did, even at the sort of height of Netflix offering things I like.
Interesting. Um, so let's shift gears. I know you also want to talk about Facebook. There's a lot going on with Facebook too. I was talking to Kevin Kelly from Delphi Digital about Libra. That's certainly big news, but a lot going on. I think we chatted last week about the news service. I think you wanted to mention some other things about Facebook.
Yeah, so I think so. Facebook reported earnings, and for all this controversy surrounding Facebook, all the talk like, do kids use Facebook? Like maybe they don't, but they're using Instagram. Third quarter revenue was up 29%
Wow.
to 17.7 billion. Profit was up 19% to 6.1 billion. U.S. users grew steadily. The company has 2.8 billion users across its apps. So any idea that there's weakness in Facebook or that any of this controversy is hurting the company, it's really a complete fallacy. There's a lot of reasons to not like Facebook as a business. Certainly their treatment of political ads is one, but you have to be there on one of its platforms. You can get rid of Facebook, but you need to be on Instagram or maybe you're not using Messenger, but you're using WhatsApp. Like this is a very successful company that maybe has some explaining to do to its customer base, but it has not been hurt by its controversies yet.
But so some of I remember hearing or reading about that there were some users that I guess departed, maybe it was last year, departed Facebook and they had some attrition. That doesn't seem to be the case, and it doesn't seem to be an impact based on the earnings calls.
So there's definitely some movement of younger users to Instagram,
hmm
but the overall monthly active and daily active users on Facebook has, for the most part, steadily gone up.
hmm
Because even people who cut down on Facebook, that's still where your grandma is. That's still where your friends post pictures of their cats. Like the Facebook is how I know when it's somebody's birthday. Like I am uniformly bad at remembering my friends and my family's birthday, with the exception of my brother because he's born on Christmas Eve. So other than that, I'm bad at it, and Facebook tells me. So am I on Facebook as much as I used to be? I don't post as much, and I certainly have leaned away from politics because it can be sort
Oh
of very,
yeah,
very negative energy.
yeah.
Um, but I don't think I'm leaving Facebook anytime soon. Now, the other big story this week was that Twitter decided to bar all political advertising,
hmm
which is somewhat like me saying I'm going to bar all supermodels from dating me. There wasn't a ton of political advertising on Twitter in the first place, so they're getting rid of something that they didn't really have.
Yeah. Is Twitter as popular still? I mean, I know that it's often reported what people tweet. We won't go
So
into politics here, but
yeah,
that's often Go ahead. I'm sorry.
Twitter has stabilized and slowly grown in the past couple years. It's a very good, information platform. And the challenge is they're a little bit hypocritical. When you're saying we're not going to take political advertising, but you're allowing politicians to speak to millions of people, and there is no sort of mechanism for, well, what they're saying isn't true. And we certainly know who I'm accusing of that because it happens a lot. If you could directly communicate with millions of people and don't have to be factual when you're a verified public figure, that's a big challenge. So in a lot of ways, this is posturing. It's, oh, hey, look, we're being good. Please don't look at this other area where we're really terrible.
Yeah, let me ask you a question just to kind of wrap up the segment. I read somewhere that Uber was getting into financial services, and I wanted to get your take on that because that totally, we've been reading about WeWork and other companies
So,
where the
so
valuations have not lived up. Go ahead, I'm
yeah,
sorry.
I actually went to the press conference where this was announced out at Money 2020. They're not going into financial services for you and I, unless we happen to be Uber drivers on the side.
Okay.
What they're doing is they're partnered with a company called Green Dot. And Green Dot is a banking as a service company. They provide banking services for non-banks. No matter how big you are as a non-bank, it does not make sense to go through the licensing and all of the various compliance to be a bank. So Green Dot, for example, provides back-end support for Walmart's debit cards. In this case, what Uber is doing is they are giving their drivers a debit-like account where they can transfer the money they've earned after every single ride. So instead of having to wait a period to be paid, they can be paid right away. It's really fits into them defining themselves as a gig economy company, because when you babysit, which would be the sort of original gig economy job, you don't get paid a week from now. You get paid, dad hands you cash before he drives you home. So this is doing that. It's also addressing some of the pain points. If you're driving for Uber and you need a tank of gas but don't get paid for 2 days, that's a problem. Uber has also decided that they're going to offer drivers a $100 loan, meaning if you start your day with your account at zero but need to fill up or need to replace a windshield wiper blade or need to get lunch or whatever it is, you're going to be able to go in the hole in order to still be able to drive. So this is the company really addressing the needs of its drivers. And in parts of the world, not the United States, it's actually dealing with its biggest problem, which is that potential drivers don't have a bank account in the first place.
Yeah, and let me tell you, based on the show, since we're a show that focuses on saving, got to tell you, I like the fact that they're giving people access to banking and helping people do that, because the quicker people can get it into their accounts, the quicker then they can put it away into an interest-bearing account of some type. Dan, it's always... Oh, go ahead.
And more importantly, let me just finish. One of the things they addressed on stage was overdraft fees. So this is a way to have money accessible to you where you won't incur overdraft fees, because if you get a $25 tank of gas and go $1 over in your account, that's probably a $35 extra charge for that tank of gas. So this sort of protects drivers. Chances are you're not financially independent if you're an Uber driver. There's a decent chance you need the money. You're doing it for that particular reason. So this really addresses that pain point.
It certainly does. Well, Dan, thanks so much, and we'll see you on Tuesday on BRN AM. Talk a little technology and a little Money 20 and maybe some other surprises. Take care, my friend.
Thanks for having me.
Welcome back, and now it's our personal finance segment. Joining me on the line, she is a personal finance reporter for The Motley Fool, Miss Mari Backman. Hey, Mar, how are you?
I'm doing well. How are you, Jeff?
I just feel like it's like deja vu for me. I feel like we just spoke, but I'm doing really well. Glad to have you back on the program to talk about personal finance, and there's a lot going on there. So, what's top of mind? What's been top of mind for you and the staff at the Motley Fool this week?
Well, one thing I'm thinking about a lot, just because now that it's officially November, I kind of feel like now that the Halloween decorations are gone from all the stores, are being replaced by the Christmas lights and whatnot, we're getting into the holidays, Jeff, and joyous as that may be, the holidays are an expensive time for a lot of people, and it's a time when a lot of people inevitably wind up in debt.
Yeah, I second that, and I'm dreading that. The Black Friday, and I know people are excited about that, but I'm really, just knowing the consumer debt numbers out there. We just did a segment this week on student loan debt, which is $1.5 trillion. I'm real concerned.
Yeah, exactly. And credit card debt is a little bit more dangerous usually than student loan debt, just because interest rates on it can be exorbitant, and actually too much credit debt can also hurt your too much credit card debt can hurt your credit score, which then kind of kicks off this cycle where the next time you really need to borrow money, it's more expensive, and it's just problematic. So I'd love to kind of offer a little advice on how to maybe lower that debt or avoid some debt this holiday season.
I love that. And I was just thinking about, before you do, it's almost like a Dear Mari segment, Dear Abby. I don't know if listeners may not be familiar with that, but do tell, what can people do? Because I'm really concerned about this for other people.
Yeah, I am too. So one of the things I like to tell people I know is first things first, just create a budget. Figure out, well, how much money do I have available? How much do I feel comfortable withdrawing from savings? Do I have savings for this purpose? Keeping in mind that if you have an emergency fund. That's money for real emergencies, like your roof collapses or your car just plain won't start. You shouldn't really tap your emergency savings for the holidays. But let's say you have some other savings. Maybe you have a small amount you can withdraw from there. Maybe you get, maybe you bring home $3,000 a month, in paychecks, and your expenses only cost you $2,500. So therefore you've got that $500 to work with. Whatever it is, figure out how much money you have available to work with, figure out the different things you'll need to spend money on, and then reconcile them. So that if example, you're looking at maybe $1,000 to work with total, and you want to fly home for the holidays, and you also want to get people gifts, and you also want to host a party, well, something's probably going to have to give, if depending on what your flights look like and how extensive your gift giving list is. So map that all out in a budget and kind of figure out what you can afford to spend, and then back into that number. Don't go out and spend and see where that number takes you, because that's how you wind up in debt.
Yeah, that's like going to the car dealer and saying, I want to pay this much a month. And then you amortize a car loan out 10 years to get to that number, and you buy too much car. I just really, I agree. We need to caution folks. And I think people know this. I think part of this, Mari, is that, there's this, people need to not go on social media. They need to not have the fear of missing out, because no one is not dealing with issues, or no one has, some people have more or less, but it doesn't really matter, right? And put those things aside and just maybe, dial down some expectations.
Absolutely. And the thing is, I like to tell people that really during the holidays, when people are getting inundated with gifts, there sort of comes a point where store-bought gifts become a little bit less meaningful. So if you are working with limited funds, give something from the heart, make something homemade, or instead of maybe getting someone an elaborate gift, just do something nice for that person, so that, for me, I've got 3 young children. Rather than get a $100 gift card to my favorite store or like an expensive gadget, the best gift anyone could give me right now is, hey, come offer to watch my kids for a couple hours and, in the evening, so that I can, go out or get some stuff done. That doesn't cost you anything. So get creative if funds are limited, because there's no sense in racking up debt when you could probably do something more meaningful for the people you care about for less money.
P.S. What is the hourly rate for a babysitter these days?
Oh, it varies a lot. I mean, where I live on the East Coast, you're probably looking at between $12 and $20 an hour, just depending on who you're getting to watch your children and what exactly they're doing. I tend to pay more for babysitters when my children are awake and they're actually feeding them and taking care of them. Mm-hmm. If I've got a nighttime sitter, I'm a little cheaper, to be honest, only because the way I see it, you're coming into my house to just sit and watch TV and eat my food, and you're probably not even going to see my kids because they're asleep. But yeah, that's childcare, babysitting. It's a lot.
Yeah,
so it's a good gift to give if you know people who need it.
Absolutely, and I think in my family, what we try to do is, we're not really big on the gifts. I think we kind of outgrew a lot of that. So a card's always nice. My parents always love cards. My brother and sister-in-law love cards. I'm working on that. My wife and I don't really exchange a lot of gifts, although we really haven't talked about that, so I don't know if she's listening to this podcast, but something to discuss. But I think for us it's about being together and appreciating each other, and less about the material things. But everyone's different.
Yeah, I think that's great though. In my family, we don't do a lot of physical gifts either. My husband and I, we plan an activity that we each plan an activity that we can do together. A lot of times with the kids, instead of giving them physical gifts, we'll say, all right, for the holidays, one of your gifts is we're going to the circus, or, we're going here, we're going there. And that way, we're just also just not racking up all this clutter at home too, which gets to be problematic.
Yeah, it's more about the experiences with family and friends, and less about having a toy or a video game to play with.
Exactly.
Well, that's really good sage advice, and people should, be mindful of that. Let's shift gears a little bit. I know you wanted to talk about selecting a financial advisor, because financial advisors do serve an important role, and now they're becoming more like financial coaches, or almost like financial fitness coaches. So what can you say about the advisory business and helping people out there pick an advisor?
Yeah, so now that we're getting sort of like toward the end of the year, a lot of people are coming up with their New Year's resolutions, and one thing that tends to be common is, oh, I want to save more money, I want to get on track financially. The tricky thing about financial advisors, they tend to get a bad rap. And the reality is there's a lot of good ones out there. You just need to kind of know how to find them. So step number one in that regard, first of all, is solicit recommendations, because if you have friends or family members who are happy with an advisor that they're using, chances are you'll have a good experience too. But I do kind of have a short checklist that I like to tell people to sort of, aim to tick each of these things off your list when looking for an advisor. And the first one is you need to understand what you're paying that advisor. Mm-hmm. So just like you and me, financial advisors need to earn a living, and there's nothing wrong with that. There's two common compensation models that they use, and one of them is earning commissions on the specific investments they buy for you. And then the second is they take a fee. Yep. That's calculated as a percentage of assets under management. I tell people that the second model is generally a little bit better. It's not to say that you can't find someone good who uses the first one, but basically that way you don't have to sit there worrying like, well, did my advisor recommend this particular investment because he or she is getting a larger commission? When you're just kind of paying that overall fee, you don't have to worry about that as much, I don't think. And then the other thing too is that your advisor is clearly invested in helping your assets grow, because that ties into his or her income. So I think that's a good setup.
Yeah, I mean, you should certainly, like buying a car, which I referenced earlier, or buying a dishwasher, or whatever you're buying, you should know the costs. And I think the key word here, Mari, is transparency, right? I mean, knowing
exactly
the costs of what the advisor is being paid, and you can justify whether or not you're getting value as an individual from the advisor, right? You can determine that based on conversations. But also, just knowing the fees you're paying is half the battle. Like
right. And speaking of transparency, another important thing on my list in terms of finding an advisor, find someone who's honest about risk, because there's no such thing as a risk-free investment, right? So anytime an advisor wants to tell you, oh, I think you should be doing this or doing that, you want to understand the level of risk that you're taking on. And I think it's only fair that the advisor, that you're working with make that abundantly clear. And that actually leads into another point. I like financial advisors who aim to educate. Sure, they're the professionals, they're the ones who come in and make recommendations, but they should also, I think, a good advisor is someone who will kind of teach you how to make smart financial decisions too. And then finally, and this is important, it's great to have an advisor who holds to the fiduciary standard, which means that your advisor must always put your best interests first. Yeah, and that's important because advisors can hold to what's called the suitability standard instead, which means that they're obligated to recommend investments that are, quote unquote, suitable for you. But suitable doesn't necessarily imply best interest. So I like that added step that the fiduciary designation offers up.
Yeah, it's like the highest standard under the law, the fiduciary standard. And so it sounds like people should be mindful of the fees, the transparency, and then whether or not someone is a fiduciary, because if you're a fiduciary, to your point, you're supposed to take someone else's interest put someone else's interest ahead of your own. And you can only know that by asking the question and pointing and having someone point to their Form ADV or to their contract document to say, we are a fiduciary for your assets.
Right.
Yeah. Well, Mari, that sage advice for the holiday. I'm ready to go holiday shopping, and I'm ready to pick a financial advisor. Really appreciate you coming on the show, and we'll look forward to having you on later this week on the television network on BRN AM to talk about maybe some tax misconceptions and spending in retirement. So looking forward to talking with you a little bit later in the week, but next week I should say. And thanks for coming on, and have a wonderful weekend.
Thanks, Jeff. You too.
Welcome back, everyone. And now we're going to talk a little real estate. And who better to talk real estate with than Jacob Passy, real estate reporter with Market Watch. JP, how are you?
I'm good. Yourself?
I'm doing well. It's Friday when we're recording this, but when people are listening, hopefully it'll be a nice weekend. I'm doing real well, thank you. So what might be top of mind or is top of mind for you? I know we haven't spoken in a week or two, but what have you seen as the top issues in real estate this week?
Yeah, so I got the chance this week to go out to Austin, Texas, because this week it was the annual conference for the Mortgage Bankers Association, which is one of the larger trade groups in the real estate world. And a couple of interesting announcements were made during the conference, one that were both regulatory. So the first one was that Secretary Ben Carson announced that the Department of Housing and Urban Development and the Department of Justice have basically formed an agreement to kind of change how they go about, investigating claims that lenders are violating federal regulations around lending. So why this is a big deal? So basically this applies to FHA loans. So under the Obama administration, the Department of Justice brought a number of cases against major banks, primarily, but all sorts of lenders, claiming that the companies had violated the False Claims Act, which is a law that basically makes companies liable if their actions somehow defraud the federal government. So basically, the Obama administration in a lot of cases said that they weren't underwriting the loans properly, and then these were FHA loans. So if the borrower is defaulted, those loans are insured by the federal government, aka the taxpayers. And so basically the Obama administration made all of these multi-million dollars, in some cases multi-billion dollar settlements with large banks and lenders, collecting around $7 billion through these settlements. And as a result of all that, major banks and credit unions basically stopped offering FHA loans. Which was a big deal. The share of banks that made FHA mortgages. So back in 2010, 44% of FHA loans were written by banks, but by 2018, that figure had dropped to only 13%. And this is significant for a number of reasons. One, there's theoretically an extent to which there's less competition in the market. Non-bank lenders have moved in to fill that gap for sure, but those companies are subject to some slightly different regulations, which can have effects on borrowers. But also it's a big deal from, a taxpayer perspective. Basically, banks are better capitalized than non-bank lenders, and so when their loans go into default, if they have them, in their portfolios still, they can cover some of those losses, whereas, otherwise, with non-bank lenders, it's often the taxpayers that are, dealing with that. So that's a big deal, and it'll be interesting to see, a lot of major bank CEOs like Jamie Dimon at JP Morgan basically blamed that whole regulatory scheme for why they stopped offering as many FHA loans. And so, it'll be interesting to see if some of the banks start, offering these again, now that the Trump administration basically has said that they're going to take a different approach. And, it's not that, I spoke with regulatory lawyers during the conference to get their take on this.
Yep.
And, they kind of said that, it's not like the banks are not, subject to regulation anymore. They're still being regulated, but, the way in which they're being regulated is perhaps not as, as risky to them in a sense. So basically, the idea was that, the fear of, having one of these large settlements made against you was largely what was causing banks to exit this market. So, in a new regulatory scheme where things are handled a little bit differently and there's a little bit more certainty as to what you can expect in terms of, regulation and stuff like that, theoretically, banks may come back. So that was, I thought, kind of, a pretty interesting thing.
Yeah, it sounds like, Jacob, that there's a bit of it sounds like, just in my head, and obviously were there, it sounds more of a middle ground step, like maybe the banks felt like the other. It seems like what you're intimating is that the banks felt like the previous regulations were a little bit too onerous, prevented them from really staying in that business. Now this kind of walks that back a little bit perhaps, and now people might be more apt to offer these loans, which
True.
would be a good thing for people who are maybe look back to our other conversations about people looking for homes and not being able to get one, right? I mean, obviously the cost of the home is a big deal, but being able to get FHA housing loan is you have to put aside less money, is my understanding, right? You don't have to put aside the 20% down, right?
Yeah, well, I mean, these days you don't really need to do that anyway.
Okay. I'm old school.
I mean, the reason to put 20% down is because if you do that, you don't have to then pay for mortgage insurance.
Right. Okay.
So, Fannie Mae and Freddie Mac both offer loan products through lenders that allow for as low as a 3% down payment, and then there are down payment assistance programs that can get you even below that if you don't have that money saved up.
Yep.
But if you get a Fannie Mae or a Freddie Mac loan with less than 20% down, you'll have to pay for mortgage insurance. And then if you get an FHA loan, your down payment can be as low as 3.5%, but you'll be paying basically a fee through the life of the loan, kind of to the FHA. It's a little different. It's basically insurance, but with Fannie Mae and Freddie Mac, it's private, whereas this is public. Anyway. All these are kind of the minutia, but yeah, the FHA loans are definitely thought to be not necessarily more affordable, but they're more they have lower requirements in terms of credit scores and things like that than Fannie Mae and Freddie Mac loans, which makes them more available to low and middle income borrowers. So definitely a good thing for a lot of people, or possibly a good thing. I mean, it'll be interesting to see. In a way, I almost think that the government, the Trump administration, is almost calling banks bluff. And we'll see if they really do re-enter this market now that they seem to have this assurance that they won't face as many of these, huge settlements through the Justice Department per se. So it'll be interesting to see if they do actually come back to this market.
Yeah, and I didn't mean to take you off. I know you were really focused on the conference. And again, I don't mean to take you off of the FHA discussion. What else was of news that you can share in the next couple of minutes with us from the Mortgage Bankers Association? Sounds like a very interesting conference. How many people were there?
I have no idea. Lots of people.
Thousands.
A lot of it is like kind of inside baseball, kind of the nuts and bolts of the mortgage industry and the machinations behind the scenes. But another big announcement that was also kind of regulatory that came out during the conference was the Federal Housing Finance Agency, which is the regulator for Fannie Mae and Freddie Mac, came out with basically its new expectations for the two of them. It really does this thing called an annual scorecard, which are basically targets that the two companies need to meet. And for the first time, these targets were very much designed with the idea that they are going to be exiting conservatorship. So as listeners probably remember, during the housing crisis, the two of them failed, and the government swooped in to bail them out. But they've basically been in this conservatorship ever since. Unlike a lot of the banks that had to have government assistance during the crisis, those banks have largely fulfilled whatever their obligations were. But Fannie Mae and Freddie Mac are still kind of in this limbo where they're until recently they were sweeping pretty much all of their profits to the Treasury Department to repay the money that the government had given them to bail them out. So the Trump administration, I think we talked about this before, the Trump administration has released its plans or its kind of proposal for how to get them out of conservatorship. And some of that stuff is administrative, so it doesn't require Congress to make any moves. And so we are kind of starting to see what that's going to look like. But one interesting thing, so we got to talk with Mark Calabria, who is the head of the FHFA. He's the director. The members of the press got to speak with him a bit. And, one of the things that was brought up in the Trump plan and that he kind of echoed in his own kind of talks on this subject is that Fannie Mae and Freddie Mac are going to coordinate with the Department of Housing and Urban Development to ensure that there's less overlap between the loans offered by Fannie Mae and Freddie Mac and FHA loans. So kind of like we were just talking about, Fannie Mae and Freddie Mac also offer these low down payment loans, 3% down loans, that are very similar in a lot of ways to the FHA's 3.5% down loans. But kind of ostensibly, FHA is intended to serve a different segment of the market than Fannie Mae and Freddie Mac, and there are concerns that Fannie Mae and Freddie Mac are lending to riskier borrowers than they should, and could put themselves in kind of a similar scenario that they were in pre-2008, 2006 when the subprime mortgage crisis happened. So the question I asked was, when I hear them say, we're going to look at this overlap, to me, I'm wondering, what I was wondering was, if they address that overlap, does that mean fewer loans are going to get made and fewer people are going to get mortgages? Because if Fannie Mae and Freddie Mac are stepping back from certain types of loans that they were offering, by which I mean that lenders are offering and then selling to Fannie Mae and Freddie Mac, because they are not themselves lenders. To me, that means that fewer people, that could cut down on the availability of mortgage credit. He kind of shot that idea down, and he kind of said that no, we're going to make sure there are no gaps. No one's going to be left behind because of this, but we're basically just making sure that people are getting the most appropriate mortgages for them, and that that borrowers aren't getting riskier loans than they should, et cetera.
Yeah.
So that was kind of his response. I think it'll be interesting also to take a look at that and to see if this does see what comes of this. If the FHFA basically tells Fannie Mae and Freddie Mac that they can't offer certain loans anymore, it'll be curious. I'm curious as to what he said as to whether or not there will be gaps if that'll be true, because it would really take a concerted effort from other loan programs through the FHA, VA, et cetera, to fill that gap if it's created.
Yeah, it's going to put pressure on these other systems. Just real quick, in the last 30 seconds, did you get up to stand up like they do in the presidential press conferences and say, Jacob Passy from MarketWatch, I have this question? And did you grab the mic? Did you grab the mic? And
no, it was in all frankness, it was about it was him, a couple of his aides, and then about 6 reporters just in a conference room. It was not as fancy as a typical government press conference. This was just kind of last minute kind of press availability, because they made that announcement that morning and knew that a bunch of us were there covering the conference. So very informal and low key or whatever.
Oh, I hear exclusivity, and that's why folks should be listening to this show and reading Jacob Bassett, because he has apparently exclusive access. Jacob, always a pleasure talking with you, and we thank you so much for sharing your insight about the conference. Lots of really good information there. You have a great weekend, and we will talk with you soon, my friend.
Take care.
Bye. Welcome back. Now we're going to shift gears, talk a little bit about retirement. I mean, we talk about retirement on the show, but we're going to specifically talk to MarketWatch's retirement reporter, Miss Alessandra Melito. Hi, Allie. How are you?
I'm good. How are you?
I'm doing well. Happy Friday, but we're really playing this on Sunday, so happy weekend.
Yes, happy weekend.
So, what's top of mind for you this week? I know there's a lot going on in the retirement space with legislation, regulation, but what's been piquing your interest?
So I have been doing a lot of stories on different studies that have been coming out this week, and one that was particularly interesting to me was about how where you live may affect how long you live in retirement. So everybody has life expectancy, of course. Women are expected to live a little longer than men, but at current location after retirement actually plays a role in your lifespan. So according to research from people at Stanford University and the Massachusetts Institute of Technology, and based on Medicare beneficiary data, they noticed that people had I think it was like 5% longer lifespan if they moved to an area that had a beneficial impact on life expectancies in general. This wasn't the case for everywhere. You know, there were some outliers, of course, like Santa Fe and Denver. But if you were to move to northeast parts of the country, like Vermont and Maine, and as well as parts of Florida and California, there was a more favorable impact on your life expectancy there. And conversely, places in the South and Southwest were not so good. They had a less favorable impact on life expectancy. So I just thought that was interesting, because you don't necessarily think about how where you live could affect how long you live, but evidently that is a possibility.
Yeah, so is some of that, based on your research, is some of that related to stress levels? Like, obviously if you're living in and around New York City, I would think that there'd be higher stress levels. Could it be also diet, what people tend to eat, where people are healthiest? So is there any sense there that what led to these better mortality states or areas?
Yeah, so there were some environmental factors like temperature and pollution and things like that, which can have, if they're not very good, they can have a negative effect on your health and obviously your health care. But then there are like those locations that were more beneficial or had a favorable impact. There were things that made behavioral changes in a person. So, for example, if you are in an area that had, a favorable area would be somewhere where there was less extreme climate, less pollution, fewer automobile deaths and homicides, but also places that had more, potential for physical activity, and places where you could expand on a hobby or, become a little more cultural by going to the museums or going to the parks or things like that. So I think people sometimes take for granted the types of activities that you should be doing in retirement. There have been studies that show that if you don't stay active in retirement, you can suffer from cognitive decline, and stay mentally active, stay physically active, and that obviously plays a role depending on where you live. So if you live in an area where you can't walk to anything, exercise might be a problem, unless of course you walk around cul-de-sacs all day, which is also a thing that people do. But it might not be as fun for you, or you might not have as much joy if you're walking around the same mailboxes every day. Like, you should want to do something that you enjoy, and for that might be something like taking public transportation to a nearby library or a museum or some sort of community group that has, regular activities that you enjoy, things like that. And obviously that's where location it gets involved.
Yeah, I wonder how many people, we often talk about the numbers, right? That's oftentimes when we are in this business, we talk about how much you need at retirement. We talk about how much healthcare is going to be, but we rarely talk about, I think, where do people want to live after. I think it's something that comes up kind of later, but you kind of need to be thinking about that, I would think, a little bit earlier than at retirement, Allie. I feel like you got to think about where you want to be and think about this a lot earlier on, like when even before you get to my age, which is in your mid to late 40s. I think you got to really think about that to really figure out. Go ahead. I'm sorry.
Not only think about it, but also experiment with it. So you don't have to do that in your 40s or even in your 50s. But say you plan to retire at 66, and you love the idea of retiring by a beach. And that's something that you've always pictured. You're going to go to the beach, you're going to have a great time every single day of your life. But if it's an area that it's only a beach town, maybe like half of the year, you have another half of the year where it could be terrible weather, or it could just be dreary, or everything could be closed because it's a beach town and everything closes when it's off season. So retirement coaches and financial advisors and everybody else will typically suggest that somebody who has plans to move to an area that they are only familiar with during the peak season, that they experiment during the off season. And that can mean taking a month off from work, like accruing all the vacation time and taking that month off and going to that beach town that you love so much during the off season and see what it's like to retire there, because you might have this envision this like beautiful retirement where you're like hitting the beach every single day and you get a sandwich at your favorite spot by the beach and all that fun stuff, but it might not be so fun for 6 months. And do you really want to like commit to that without experimenting or like just testing the waters? And what else? And this is especially true if you are planning to leave like the state or the country. A lot of people will want to retire abroad, and that's cool. But before you do that, you should probably spend some time there, more than like a 10-day vacation, just so that you can see what it's like. What if you need a doctor? Like, is there a doctor nearby where you plan on living? Like, does the language affect you? Like, all these different factors go into like choosing a location. And obviously, then there are the money, or like not even just money, but like, so yeah, taxes and cost of living are factors that you should take into consideration. But also public transportation. Like, do you need a car where you plan on living? Do you want a car where you plan on living? How can you see family and friends? Like, is there a train line that gets you somehow back to your old home so that you could see kids? So there are many, many factors to consider before moving.
Yeah, Allie, we've got about a minute left, but I would think that this is really an underestimated part of what people consider at retirement. I got to believe that. I got to think that people can oftentimes make the wrong mistake of not doing what you're suggesting or what experts are suggesting, which is testing the waters. And they go there and they're like, this is great. And then you just wind up and like, oops, my wife and I made a mistake.
Yeah.
We didn't, or my husband and I made a mistake, or I made a mistake. I mean, it's just, I think, instead of, it's just something that you really need to contemplate and think about outside of the numbers, because it's very qualitative, right? I mean, it's really up to you, and those things matter. Where you're going to get health care, I mean, that matters. I guess theoretically, you could, if you left the country, you remain an American citizen, and so would you still be covered under Medicare? Would you, had to buy Medigap? I mean, or would you be part of the new country's plan? Probably not. I don't know. I mean, all those things have to be factored in.
Oh yeah, and that's definitely like the year before you actually plan on moving. Aside from the fact that you should definitely like test it out before you do it.
And you should definitely maybe learn the language if you're going abroad and they do not speak your native.
Yeah, some people say they don't care that they don't understand the language. I don't know, but that's a personal choice, I guess.
Yeah, I think I would do my best to kind of meld in with the culture as opposed to not being part of the culture. But I guess you can do that without speaking the language, although I think it'd be difficult to go to a restaurant, order a sandwich or something. Allie, always a pleasure talking with you. Great topic, and I think many people are not thinking about it and need to be. Thanks so much for the contribution, and we will talk to you again next week. Have a wonderful weekend.
Bring it to Bye.
Welcome back, everyone. And now we're going to wrap things up as we always do with a chat with the legal eagles. Both David Levine and Kevin Walsh are principals, I should say, not principals with the Groom Law Group, an employee benefits law firm. Gentlemen, Eagles, how are you?
We're doing well. It's always good to appear on the show, Jeff.
It is. I agree. I mean, because I'm on it every day, every week, and I appreciate you. We appreciate you. The audience appreciates your contributions, of course, to the show. So what's top of mind for you, gentlemen, this week? Lots going on in Capitol Hill, I would imagine.
Yes, well, it's been a quiet week in Washington. Nothing to do with baseball. Go Nationals or impeachment. So the most important thing at the top of the list for everybody is, of course, because you're going to ask us, the Secure Act. Where does it sit? Everybody is still working to see if it can move forward. There's been a lot more efforts going on. There's talk that maybe some of the concerns that have been holding it up may be easing, and so maybe some of the holds are sort of going to move off, but no guarantees until legislation passes. So the simple answer is, given impeachment, the fact that we're still trying to get to budget frameworks, even
Yeah.
in the Senate. It's still iffy at best, but at the same time, we'll have to see where it goes. But every week we will promise you your insecure your insecure update on the Secure Act.
I appreciate that,
So,
guys.
so David, it sounds like you're not as pessimistic as a Nats fan was after Game 5, but you're not as excited as a Nats fan was after Game 7.
Correct. I'm kind of like an Astros fan was after Game 2, but a little better after Game 5, but not exactly after Game 6, and definitely not after Game 7. So if you can translate that, Kevin, into what it feels like, I'll be even more impressed.
So it's a lot like a Nats fan after Game 4.
Maybe, maybe not. But, you know, Kevin, we're not supposed to talk about the Nationals here, even though, yes, they're great. So given that, what else is on your mind? Maybe from the opposite coast?
Yeah, from the opposite coast. I mean, if we turn from DC and we start looking at Dodger Town or California, kind of the big thing kind of this week on my mind is getting ready for CCPA to come online at the beginning of next year. And there won't be enforcement for the earlier of July 1 or 6 months after we get final rules. But, having taken a look at the proposed rules and taken a look at kind of the updated text post amendments, there's kind of this really murky area right now, which is, employers are going to be required to provide a notice that describes the categories of information that their plans are collecting or that they're collecting from employees. And they're also going to have to include in that notice kind of how they're using that information. And if you look at the proposed regs, they describe the notice that you provide, but the reg was clearly prepared before CCPA was amended because it discloses a whole bunch of information or talks about a whole bunch of types of information that really aren't relevant in the employee-employer context anymore. So if plans are required to include this information or employers are required to include this information, it could lead to a lot of confusion. So I think top of mind this week is really trying to work with the Attorney General out in California and work with major stakeholders to see if there's a way that we can kind of figure out how to get this disclosure right before it has to go online next year. David, do you have any thoughts on CCPA? I mean, I know that early December is kind of the time to make a difference here.
It is, and I agree with you wholeheartedly, Kevin, in what you're saying. I think let's talk about what do you do at this point. If you're an employer at this moment, it seems to me you're starting to go down this road, as Kevin knows as well. We're working our way through this with some of our clients who are based in California. How do you start dealing with this? What do you put in the notice? It's going to be an evolving landscape given the AB 25 and the proposed regs, and they don't exactly reflect the employment carve out for next year. I think right now it's kind of like you do your best and sort of move forward. Similarly, if you're a service provider, and this question came up to me this week, what do you do? And I think the very basics of that is, I think you figure out, okay, who's responsible? Do you want to provide support to your end client? Do you have a direct obligation? I think in some cases, it's really good. You need to look at this holistically and say, well, what are my positions? Am I doing things through the employer? Am I doing it through the plan? Is it not through the plan? There's no perfection here. But now is the time, as we sit down with people, we're starting to categorize these items and try to come up with a holistic solution. So to me, right now is a thinking and evaluation, but recognizing there's no such thing as perfection. But Jeff, can I toss in one extra tidbit for this week?
Absolutely. Of course.
Well, one more thing to talk about this week, as we know, it's good to touch about the MIT settlement again, and yes, to beat a horse that Kevin and I like, there is yet another provision about sort of data usage in there, and it's important to look forward. I think the takeaway, and you're seeing everybody in the retirement and benefits universe being focused on this. It's not just about the sponsor, it's the service providers. And I had a talk with a service provider this week about this, and I think the key takeaway is, as people are starting to say, well, what do we need to do here? It's important for everybody to understand what their products are, whether you're a provider or a sponsor. How does it work? How does the data get used? What type of consents are you doing? And how are you documenting? There's nothing that says you can't do what is in terms of services and products, but what is your process and what are your steps? And making sure everybody dots their I's and crosses the T's is the key. It doesn't mean you have to change the world, but you have to figure it out. But that's just my takeaway, unless Kevin tells me I'm completely wrong on a Friday afternoon.
David, when you said one more tidbit, I was sure you were going to go to missing participants, but I appreciate the talk about the MIT settlement just as well.
Well, gentlemen,
wait. I'm going to go missing now because Jeff's going to hang up on our recording right now.
I am not going to hang up. I was going to say to you guys, thanks so much for appearing. I know one of you is in, I think Kevin's in transit, and we really appreciate it. And congratulations to the Nationals as a Baltimorean, a former Baltimorean, or congratulations. And I'm sure you guys are very excited. That's your second win in 2 years as a city, so that's awesome. Now if the Redskins can get their act together.
Yeah, I mean, the DC, we've got the Mystics, who are the champions now. We've got the Nationals, who just won, and we have the Caps, who won the Stanley Cup a couple years ago. It's not quite City of Champions because the Redskins don't seem to be able to win any games, but things are looking up.
Yeah, or the Wizards, but
or the Wizards for that matter.
Or the Bullets, as they were once called. Anyway, gentlemen, thank you so much for your time. Have a great weekend. Enjoy your trips, and we will talk to you again next week.
Thank you, Jeff.
Thanks, Jeff.
Bye. Well, that wraps up BRN Sunday podcast for this week. Thanks for joining us, and we look forward to having you back again next week. Have a great rest of your weekend, a great work week, and don't forget, tune in to BRN AM each day this week. So until next week, I'm Jeff Snyder. Talk to you soon.